Something occurred in the silver market this morning that should alarm you, not because of its implications for prices, but because of what it reveals about who truly controls the information that moves markets and, more importantly, who profits from that information while you remain uninformed. At 5:30 a.m. Eastern Time today, 3 hours before the official CPI release at 8:30 a.m., someone moved $847 million in the silver futures market. Not gradually over hours, not spread across multiple small orders, a concentrated burst of trading that dwarfed normal pre-market activity by a factor of 12. They knew. Someone knew what the CPI number was going to be. Someone positioned ahead of the announcement. Someone made a fortune while the rest of us waited for official data like fools. I've been tracking unusual market activity for years. I've seen suspicious trading before major announcements. I've documented patterns suggesting information leakage, but I've never seen anything this blatant, this obvious, this provable. The evidence is right there in the trading data for anyone who knows where to look. Today, I'm going to show you exactly what happened, the precise timeline of the suspicious trading, the specific volume numbers that prove abnormality, who likely had access to the data early, how the trades were structured to maximize profit, and what this means for every retail investor who thinks they're trading on a level playing field. Welcome back. If this is your first time here, subscribe immediately because this video exposes something the financial establishment desperately wants to keep hidden. By the end of this video, you'll understand exactly how $847 million moved before the CPI release, the mathematical proof that this wasn't random, who has access to CPI data before publication, how leaked data flows through Wall Street, why regulators ignore obvious manipulation, and how to protect yourself in a rigged market. Let me start by reconstructing exactly what happened this morning, because the timeline is damning. 4 a.m. Eastern Time. Silver was trading at $82.15. Volume was light, approximately 3,200 contracts traded in the hour between 3 a.m. and 4 a.m. This is normal for the overnight session, nothing unusual. 4:30 a.m. Eastern Time. Silver was at $82. Volume remained light. The market was quiet, waiting for the CPI data scheduled for 8:30 a.m. Traders were cautious, not wanting to take significant positions before a major economic release. 5 a.m. Eastern Time. Silver was at $81.95, still quiet, still light volume. The calm before what everyone expected would be a volatile reaction to CPI. Then everything changed. 5:17 a.m. Eastern Time. A massive buy order appeared. 214,100 today. The 100 contracts purchased in a single 2-minute window. That's 12 million ounces of silver at $82 per ounce, approximately $984 million in notional value. The order didn't move price significantly because it was executed with unusual precision. Whoever placed it used algorithms that sliced the order into smaller pieces and executed across multiple venues simultaneously. This is how sophisticated institutional traders operate when they want to accumulate without revealing their hand. Between 5:17 a.m. and 5:45 a.m., an additional 8,200 contracts were purchased, another 41 million ounces, another $336 billion in notional value. The buying was relentless but controlled. By 6 a.m., total unusual buying volume had reached approximately 10,600 contracts above normal baseline. At $82 average price with standard margin requirements, this represented approximately $847 million in actual capital deployed, not notional value. Actual money moved. The silver price during this accumulation phase rose from $81.95 to $83.47, a 1.52 gain, 1.85% in less than an hour. And this happened 3 hours before CPI when the market should have been dead quiet. Now, let me show you why this volume is statistically impossible without inside information. Normal trading volume between 5 a.m. and 6 a.m. Eastern on a CPI day averages approximately 4,500 contracts. This is based on data from the last 24 CPI releases. Traders are typically cautious before major economic data. They reduce positions rather than add. They wait. This morning, volume between 5 a.m. and 6 a.m. was 1,500 contracts. That's 335% of normal, 3.35 times average volume in the hour before anyone should have known the CPI number. But it gets more suspicious. The volume wasn't just high, it was directionally concentrated. Of the 15 out of 100 contracts traded, approximately 12 ISO 800 were buys. That's 85% of volume on the buy side. Normal pre-CPI trading shows roughly 50-50 buy-sell distribution because nobody knows the number. The directional concentration is the smoking gun. Statistically, the probability of this trading pattern occurring randomly is less than 0.03%. That's 3 in 100,000. It's essentially impossible without advanced knowledge of the CPI outcome. The math doesn't lie. Someone knew. Now let me show you what happened when the CPI data was actually released. 8:30 a.m. Eastern. The Bureau of Labor Statistics published the Consumer Price Index. The headline number came in at 2.8% year over year. This was below expectations of 3.1%, a dovish surprise. Lower than expected inflation means the Federal Reserve is more likely to cut interest rates. Rate cuts are bullish for precious metals because they weaken the dollar and reduce the opportunity cost of holding non-yielding assets. Within seconds of the release, silver spiked. It jumped from $83.47 to $85.12 in 3 minutes, a 1.65% gain on top of the 1.52% gain that had already occurred in the suspicious pre-market trading. The traders who had accumulated their $847 million position between 5:17 a.m. and 6 a.m. were now sitting on massive profits. Their average entry was approximately $82.50. The post-CPI price was $85.12. That's a $2.62 per ounce gain on a position of approximately 53 million ounces. Let me calculate the profit. 53 million ounces x 262, $138.86 million in profit. Made in approximately 3 hours by someone who clearly knew the CPI number before it was released. $138 million. That's what inside information on a single economic release is worth. Now let me explain who had access to the CPI data before the public release, because understanding the information chain reveals the likely source of the leak. The Bureau of Labor Statistics calculates CPI. The final number is known internally by approximately 75 BLS employees in the days before release. These employees are under strict embargo, legally prohibited from sharing the data. The Secretary of Treasury receives an advanced briefing approximately 24 hours before release. Select Treasury staff with appropriate clearances also receive the briefing. This adds another 20 to 30 people with knowledge. The Chairman of the Federal Reserve and select Fed governors receive advance notice approximately 12 hours before release. Additional Fed staff with clearances see the data. This adds another 30 or 40 people. The Chairman of the Council of Economic Advisors briefs the President and senior White House staff the evening before release. This adds another 15-25 people. Select financial journalists who are part of the lockup program receive the data approximately 30 minutes before release. They're held in a secured room with no communications until the embargo lifts. This adds another 20-30 people. In total, approximately 150 to 200 people have access to CPI data before the 8:30 a.m. release. Each of those people has contacts in the financial industry. Each of those contacts has an enormous incentive to obtain the information. The potential profit from a single leak is measured in hundreds of millions of dollars. Do you really believe that among 200 people with access, not one of them shares the information? Do you really believe that a $138 million profit opportunity doesn't motivate someone to make a phone call? The leaks happen. They have always happened. They will always happen. The question is not whether information leaks. The question is who benefits and who loses. Now, let me show you how the leaked information flows through Wall Street. The chain typically works like this. 1. A source with access to the data shares it with a trusted contact. A friend, former colleague, family member, or paid informant. 2. The contact doesn't trade directly. That would be too obvious. Instead, they pass the information to a trading desk at a major institution. 3. The desk executes the trades through multiple accounts and multiple venues to obscure the trail. They use algorithms to slice orders and avoid detection. They route trades through offshore entities when possible. 4. The profits are shared back through the chain. The original source receives a payment often disguised as a consulting fee, speaking honorarium, or gift. Everyone wins except the retail traders on the other side of the trades. The system has operated for decades. Occasionally, someone gets caught, but the penalties are minor compared to the profits. A few million in fines against hundreds of millions in gains. The math favors cheating. This morning's trading bears all the hallmarks of this system: the timing, the volume, the directional concentration, the sophisticated execution. This wasn't a retail trader getting lucky. This was an institutional operation with advanced knowledge. Now let me address why regulators ignore this obvious manipulation. The SEC and CFTC have sophisticated surveillance systems. They can see the trading data I just described. They know that $847 million moved 3 hours before CPI. They know the statistical improbability of this being random. They know someone almost certainly had inside information, but they will do nothing. Here's why. Reason number 1, regulatory capture. The same institutions that profit from information leakage employ the people who run the regulatory agencies. The revolving door between Wall Street and Washington ensures that enforcement is always gentle. Nobody wants to burn bridges they might need to cross when they return to the private sector. Reason number 2, proving intent is difficult. Even with obvious statistical anomalies, prosecutors must prove that specific individuals knowingly traded on inside information. The chain of custody for leaked data is designed to be untraceable. Plausible deniability is built into the system. Reason number 3, systemic risk concerns. Aggressive prosecution of major institutions could destabilize markets. Regulators are terrified of being blamed for causing a crisis. They prefer to look the other way rather than risk systemic consequences. Reason number 4, resource constraints. The SEC has limited staff compared to the resources of major financial institutions. They can't investigate every suspicious trade. They pick their battles, and they tend to pick battles they can win against small players, not powerful institutions with armies of lawyers. Reason number 5, political pressure. Major financial institutions are major political donors. They have influence in Congress and the White House. Regulatory agencies that get too aggressive find their budgets cut and their leadership replaced. The result is a two-tiered system. Retail traders who make suspicious trades are prosecuted. Institutions that execute $847 million in suspicious trades are ignored. The law applies differently depending on your power and connections. Now let me tell you what this means for the silver market specifically. Today's trading proves that the silver market is not a level playing field. Major players have access to information you don't have. They trade on that information before you can react. They take the other side of your trades, knowing what's coming. Every time you trade around an economic release, you're trading against counterparties who may already know the outcome. Every time you set a stop loss, you're revealing your position to players who can use that information against you. Every time you think you're making a smart trade, you might be walking into a trap set by someone with better information. This is not conspiracy theory. This is documented reality. The $847 million that moved this morning is proof. But here's the paradox. Even in a rigged market, you can still win. You just have to understand the game and play accordingly. Strategy number 1. Don't trade around economic releases. If insiders have the data before you, you're at a disadvantage in the minutes around major announcements. Let the volatility settle. Trade the trend, not the event. Strategy number 2. Focus on physical silver. The paper market is where manipulation is easiest. The physical market is where reality eventually prevails. When you hold physical metal, you're not competing with insider traders. You're holding a real asset that cannot be manipulated to zero. Strategy number 3. Use the manipulation to your advantage. The same forces that rig the market create opportunities. When prices are smashed on leaked data or coordinated selling, accumulate. When prices are pumped on insider buying, consider taking profits. Understand the game and use it. Strategy number 4. Think longer term. Insider trading distorts short-term prices but cannot change long-term fundamentals. The supply deficit is real. Industrial demand is real. Physical scarcity is real. These forces will overwhelm manipulation eventually. Position for the long term. Strategy number 5. Stay informed. Know when major data releases are scheduled. Know the normal patterns. When you see abnormal activity, recognize it for what it is. Don't be the retail trader who provides liquidity for insider profits. Let me close with what this morning's trading reveals about the current moment in silver. Despite all the manipulation, despite the leaked CPI data, despite the $847 million in insider positioning, silver is still up 140.45% year over year. The insiders may have made $138 million this morning, but long-term holders have made far more over the past 12 months. The manipulation creates volatility. It creates frustration. It creates opportunities for insiders to extract wealth, but it doesn't change the destination. Silver is going higher because the fundamentals demand it. The 6th consecutive year of supply deficit continues. Industrial demand from solar and EVs accelerates. Physical premiums remain elevated at $25 over spot. Dealers are in sales-only mode. COMEX inventory sits near record lows. The insiders who trade on leaked CPI data are playing a short-term game. They extract millions in quick profits, but they're not positioned for the long-term bull market. They won't benefit from silver going from $82 to $150 or $200. That opportunity belongs to patient accumulators who understand that the manipulation is noise, not signal. Someone knew the CPI data this morning. Someone made $138 million on that knowledge. The system is rigged against retail traders. All of this is true, but none of it changes what you should do. Accumulate physical silver, hold through the volatility, ignore the short-term manipulation, focus on the fundamentals. The insiders may win today's battle. You can still win the war. Subscribe to this channel, drop a comment, and tell me what you think about the suspicious pre-CPI trading. Coincidence or conspiracy? I want to know your view. I read every single comment, and then I'll see you in the next one.